Hello, this is George, and I'm today going to show you a preview to the next installment of my Easing into Easy Language series, the Trend Following edition. I've adapted my Ultimate Trend Following Guide and Kit. I'm going to adapt that into a book, and I'm going to sell it on Amazon.com. So today I'm going to give you a preview of what's going to be in that book, but you can also go ahead and take advantage of the Ultimate Trend Following Guide. I'm selling that right now, plus the data. I'm bundling that with the Data Magician, and then also my instructional manual on Portfolio Maestro. And you can get that at my digital store. Just visit my website, georgepruitt.com. Today I'm going to build a trend following system, a very successful one, as you will see. And I'm keying off a concept that was introduced by Peter Way and also Keith Fitchen, in that you only take trades that fit well within your risk-averse parameter. So you skip a lot of trades if they're too risky, and trade a large enough portfolio so that you can catch a trend, because you are skipping a lot of trades. But if you trade a large enough portfolio, you should be able to catch a trend in one of the markets that's in the portfolio. Today I'm going to be using, instead of TradeStation, I'm going to be using MultiCharts. And I'm going to also be using PortfolioTrader. PortfolioTrader I've used quite a bit lately, and I have to admit that it is better than Portfolio Maestro. It's more stable, it's faster, it's easier once you get used to how it's used. So I'll probably be writing an instructional manual on PortfolioTrader here in the near future as well. So let's just jump into the trend following system. We're going to be testing commodities and commodities only. But of course, you could take this toward the stock market or ETFs if you would like. So let's go jump into the PowerLanguage editor. Here we go. Only reason I call this Pegasus-like is because Peter Waite's Andromeda and his Pegasus systems were very good systems for a very long time. And we actually broker assist traded those systems for many clients for many years. And I call this Pegasus-like because the only thing that is, I guess you could carry over from the Pegasus or aberration strategies, is that we are filtering the trades, and we're only going risk with really risk-averse entries. Okay, so how do we get into a long position? We're going to first discuss the long and short entries, and then I'll discuss the exits. The long entry is just simply a breakout of a Bollinger Band. It's the close is greater than the upper band of the Bollinger Band. And the Bollinger Band, in this case, is going to be an 85-day with a 1.5 standard deviation above and below the moving average. So we need the close to be above the Bollinger Band. And you're saying, well, that's nothing original, George. You've talked about that in many books and many videos. Well, we've added another little key concept here, and it's the slope up. And slope up is a Boolean. It's conditional, and we can define that in easy language by setting it to false. We don't put a 0 there or 1 there. We set it to false, and that turns out to a Boolean variable. So it's expecting to be either true or false. And so my slope up is basically looking at the last 3 bars and determining, incorporating today. And each bar's moving average has got to be ticking up. Okay, so, and it's got to be consecutive. So today's smooth SMA with this, I'm sorry, not smooth, that's simple moving average, is basically the average of the close, using the same indicator length as we did with the Bollinger Band. We're just comparing today versus yesterday, and yesterday versus the day before, and the day before, and comparing it to the day before that. They all got to be up, ticking up, and consecutive for slope up to be true. If one of these is not up, then slope up will be false, because we're using and. So they all have to be true for this to be true. Slope down is just the opposite. We're looking for a down tick in each consecutive simple moving average calculation. So these are Booleans. They're either going to be true or false. Okay. So if we're above the Bollinger Band and we do have a slope up, and here's where the key to this trading strategy and its success is found. I want my trade risk. What is trade risk? Well, in a Bollinger Band system, usually your trade risk, you enter at the breakout of the Bollinger Band and you get out at the middle of the Bollinger, upper and lower Bollinger Band, which is just simply the moving average. So that's your trade risk, the distance between the upper and the middle bands. So trade risk is defined up here. Or where's trade risk? Right there. And I love this. I like the differences between the different editors. The PowerLanguage editor is nice because if you type a variable that's not been defined, SMA, if you type SMA, it's going to turn orange. But say you type SNA, or SNA equals, and it's white. And you're saying, why is that white? Well, it's white because it's not been defined. And that will catch a lot of problems when you go to verify this. And that is a nice feature I like in the PowerLanguage editor. I don't think it's in the EasyLanguage editor. At least I've never seen it before. Now, I also like to use Notepad++. So if you don't use Notepad, if you don't know what Notepad++ is, you should download it. It's free. And a lot of times I just like to take my code from the EasyLanguage or the PowerLanguage editor, and I like to copy and paste it in there. And as you can tell, it's really nice and colorful and formatted quite well. And you're saying, well, why would you do that, George? Well, for example, say I need to find out where a variable has been defined. Let's look at initial risk. If I double click on initial risk, everywhere initial risk occurs in my code is highlighted. So initial risk is there, initial risk is there, there, and it's up here. So I love using Notepad for developing my EasyLanguage or PowerLanguage code, and I'll just copy and paste it back in and make sure it verifies. And I like this for this one feature. I like that a lot. Plus, I can collapse code and fold code and do things like that. And of course, you can do that in the other language editors as well. So let's get that out of there. Just wanted to throw that in there. That's free. Notepad++. I think anybody who's really serious about programming should have as many editors as they possibly need, because you can never have one editor that does everything you want, but you can have multiple editors, and the combination should fulfill all your possible needs. So let's get back to this trade risk. Trade risk is up here. It's basically just the upper band minus the SMA. And that could have been the SMA minus the lower band. It's the same distance. We're talking basically a standard deviation, or in this case a 1.5, and that's what it will be, 1.5 standard deviation. That's our trade risk. If our trade risk is less than our initial risk, and we're going to call our initial risk, we're going to call that the average true range of the past 20 days. And you're saying, why did you pick 20 days, George? 20 days is a month of trading days. 20, 30, whatever you'd like. You could change that. And then I'm going to multiply that by a max in ATR loss mult. And that's an input up here. Okay, and that's at this time it's going to be, I think I got it set to 3 in the actual testing as well as this code here. So my trade risk has got to be less than 3 times the average true range for the past 20 days. And I added this additional code, and this makes a big difference. And why it makes a big difference, I think when prices such as crude oil gets way too high, the trade risk, the distance between the upper and lower Bollinger Band can grow immensely, but so can the average true range. So you could have a really high risk trade even though you are limiting it to 3 times the average true range. And that can be, it could be like $8,000 or $9,000, and maybe that doesn't fit your criteria. Well, in this case, we're going to use a trade risk. We're going to use the max entry risk dollars. And I like putting a dollar sign on it so that I know that's going to be dollars, and I have to divide by big point value to get the number that I'm looking for. So I want trade risk, which is a amount of points, or market amount, and I want to make sure that I want it to be less than 3 times the average true range, and I also want it to be I want to have a ceiling on this. I don't want it to be greater than $4,500. I don't want that distance between where I get in and get out to be greater than $4,500 at the beginning of the trade. Now, I have a max loss of only $3,000. That says 6,000, but in the actual code it's going to be 3,000. So we can just type that 3,000 if we want to right there. Okay, so why don't I just set that to $3,000? Well, if you do the analysis, and I have, the $3,000 really shuts the trading down. Now, are you going to lose $3,000 right off the first trade? Taking that snapshot of that risk on that day of entry isn't really a true picture of what's going to happen or evolve during that trade. At times, it could be the amount could grow, or it could compress the risk. So I'm basically saying, okay, I know that at the beginning of the trade that the $3,000, I want to use that as my protective stop, but I want to be able to take a trade that is a little bit more risky than just that snapshot. I'm willing to have a little bit of a tolerance there. So I'm going to take a trade that right off the get-go is demonstrating a $4,500 loss, okay? Or the risk between the entry and the exit is $4,500. That opens up the ability or filter to accept more trades. So I'll let you think about that. Our max trade loss is only going to be $3,000, but I'm going to allow a trade to be initiated with a risk of $4,500 in hopes that during that trade it goes in our direction, and over time the entry point in the upper Bollinger Band, or the risk during the trade, will diminish to less than $3,000, and hopefully we make money off that trade. So that's the key to this strategy right here. Trade risk is less than our initial risk max NART loss amount, and our trade risk is it's got to be less than a ceiling. Okay, and you can play around with these, and you might define that it doesn't need this multiple of the 20-day average true range. I haven't played with it enough. I'll let you do that, but I just wanted to demonstrate how you can program a ceiling of risk and a function of the market risk calculation. Okay, so if that happens, if we're above the upper Bollinger Band and we have a slope up and our trade risk is within our criteria, we're going to go ahead and hit long. We're going to go long on the next bar at open. Same thing for the short entry, except we're below the Bollinger Band, a lower Bollinger Band, and we have the slope down and our risk criteria is met. We sell short on the next bar. Now here's our long exits, and the short exits, I won't go over them, they're just the opposite. My long loss is going to be the initial risk, which is the 20-day average true range times 3, or it's going to be the lesser of that calculation and my max trade loss, which is $3,000. So I'm going to let it be a function of the market. My stop's going to be a function of the market, but I'm going to put a ceiling on it. I don't want to lose more than $3,000. If 3 times the average true range is less than $3,000, we're going to go with that. It could be, $1,700, $2,000, whatever. And if that happens, we're going to put a sell order in at the next bar at our entry price minus the long loss. Okay, and this is not long loss is not a dollar value because we're converting it from a dollar value, the max trade loss, into a market price or market range. Okay, that's one exit. The next exit, if the close is less than our moving average, meaning that if the close works its way down from the upper Bollinger Band to the middle of the bands, we're going to get out at the market. Okay, and whatever happens first, do we get stopped out with a loss, or do we get stopped out by hitting the mid band? And then we have actually two more exit criteria. If the moving average clicks down 3 days in a row, okay, and then the close is less than the entry price, I'm in a losing trade, right? I'm in a losing trade, and today's moving average is less than the prior day. Yesterday's is less than the day before that, and the day before that is less than the day before that, and I'm in a losing trade, I get out at the market. Okay, that's just getting out, saying, hey, I've had the moving average, which is going to be 85 days, which is pretty longer term. I've had the moving average start pointing down, and I'm in a losing trade. This doesn't feel well. This doesn't feel good. Let's get out, and that's basically what we do there. And here's another kind of neat little exit criteria. If today's true range, so we have a wide bar, is greater than the large ATR, and large ATR is what? Well, if we had Notepad, we could just double click on it and it would highlight that for us, but we have it right here. Large ATR is going to be a user input, and I call it high vol mult, and it's going to be the average true range times 20 again. If the high vol mult, which in this case I think is 3, if today's average true range is greater than 3 times the average true range, and the close is less than the prior day's close, and we have another down close before that, then we're just going to get out of this thing, because we've had a large move against the position. Now, this could be a profitable trade or it could be a loss. It depends on when we have this large ATR, and then when we have this down close, these consecutive down closes. And so it's either a profit objective or it's going to be a stop, one of the two. Okay, the short exit is basically the same thing, except on we're flipping it over. We're still using the same exact criteria, the same numbers. It's not being curve fitted for the long side or the short side, so all that's the same. So when you run that, you'll notice it'll produce pretty good results on crude oil and other markets, soybeans, things like that. But if you really want to see how it does, you can jump over to PortfolioTrader, or if you want to, and of course you get this with if you purchase the Ultimate Trading Guide and Kit, I give you the Portfolio Maestro portfolios. You just import those directly into Portfolio Maestro. I can't do that with PortfolioTrader because PortfolioTrader keys off MultiCharts. MultiCharts has a plethora of data feeds, and I just don't know which data feed you're using, so I can't give it the symbols that it needs. I can't feed that into it for you. You have to make that up yourself. And like I said, one day I'll make a manual that shows you how to do that. So what I did with PortfolioTrader, I went in and I fed my Pinnacle data from Edpavia. It's a very good data source. I download it every day. It's end-of-day data. And basically I just mapped it directly into PortfolioTrader using the ASCII mapping. Active data sources, ASCII mapping. And basically I had to go in there and I had to set the big point value. I had to set the minimum move for each market. It's not difficult, it's just a little bit time consuming, but once you do it, it's done. And if you're using an alternative data source, say CSI, which we know is very good data, or Pinnacle data, which is very good data, and versus say IQ Feed or TradeStation data, it's always good to have multiple data sources that you run your system across to make sure it's very consistent across all data. If it's not, then you need to figure out which data is the best data, and you go with that. Okay, so basically we're just going to run this portfolio. It's called TrendFollowing Pruitt Broker Interactive Brokers. I don't have this connected to Interactive Brokers. It just defaults to that for some reason. Here's my instruments. I've got 25 instruments in there. AEN would be Australian dollar. CN is Canadian dollar. That is Pinnacle's symbology. I won't go into detail about that, but if you're interested in Pinnacle data, I would look into it. It's Pinnacle data. Just Google Pinnacle data, or it's pinnacledata2.com or pinnacledata.org. It's one of those two. But it's both those. You just go there or just Google it. So I mapped my data to it. So I wanted to trade. I wanted to do the. I wanted to analyze the signals from this Pegasus-like strategy. And as you know, I've got, here's Clownell, CAT scan aberration, Andromeda, parabolic, simple harmony-like, super turtle-like, TF Babcock, TF Cavell. All these signals and these systems come in my my kit. So you purchase the kit, you get all the code for all these systems. I'm going to run this from, here's the data range. I'm going to run that from the beginning of 2000. That's 24 years. And that's the beauty of Pinnacle data. It goes back to 1965 if you went on soybeans. So then again, that's the beauty of buying this alternative data from CSI or from Pinnacle. You can go back tons of history. I don't know if it's that helpful to go that far back or not because the markets are so different nowadays. But if you want to, you can. So we're going to run it from 2000 to 7. Well, it doesn't go through 7.3. I think my data goes through June or May or something like that. I can't remember. I haven't updated my Pinnacle data on this computer as of late. So let's go ahead and run this. And this is a beautiful thing. We'll just want to do a back test. Okay, mapping it. I'm going to run it. I mean, it's running this strategy across those 25 markets. Look how fast this thing is. This thing is super fast. Is it faster than Maestro? I'd have to say it is. I'd have to. So now we're going to go ahead and it's going to create the report for us. I'm bragging on it. Watch it bomb on me. Something, I did a patch. I upgraded it yesterday, and man, it was not working right. And so I called up MultiCharts, chatted with them, and their tech service is really nice. And there was a patch I had to download and insert into or upgrade to, and they were very extremely helpful. So let's look at the strategy analysis. It's all tree-like. You know, you got your expansion and your contraction buttons. Let's look at the performance summary. Let's look at the equity curve real quick, detailed, and just show you what we're talking about with this strategy. And it should be popping up any second now. There it is. I got worried there for a second. That's not a bad looking equity curve. Let's do equity curve close to close. Now that's tested 25 markets using $50 round turn, using just those inputs. Max entry risk is $4,500. I will take a trade up to $4,500 risk, even though my stop is only $3,000, in hopes that I'm sucking in a good trade that over time it will become a winner, or I'll have a stop of $3,000 or less. There's my max NATR loss mult. That can be 2, 3, 4. That's not a sensitive input, I've discovered. My indicator length is 85, and number standard deviation is 1.5. My high vol mult, that's an average true range calculation. If it exceeds 3 times and we have two consecutive closes against our position, we get out. So that's pretty cool. I'm going to show you the optimization of this thing real quick. I click on it twice for some reason. I don't know. I'm going to do a genetic optimization. Okay. I'm going to hit OK. And I'm going to do, this is very simple. Let's go ahead and let's do the max entry. Let's turn these off. Okay. We're going to do that. Let's do that by $125. Let's do the max trade loss. Let's do it from 3,000 to 6,000 by $25. So error, tells you error right here if that number doesn't make sense. So we got 6,000. And so we got 2,057 combination. That's probably pretty good. It probably wants you to go over 10,000. So let's do, there we go. We'll do 80 to 90 indic length. And we're going to go ahead and do a combination. There's 22,000 combinations, okay? Permutations using these parameters. So what we're going to do here is, let's see what that, I've never seen that before. Oh, standard criteria. We're going to do the net profit. And you can modify this stuff. This is kind of the best case that you can change this if you know what you're doing. I wouldn't unless you really know what you're doing. So let's go ahead and hit OK. And let's go ahead and we're going to do the optimization of this thing. I got several things running in the background. I've got MultiCharts. I've got my Trading Simula 18 open. I also have TradeStation open. I got 16 gigabytes of RAM. It's a Ryzen 5 chip. Let's give this a few seconds just to kind of give you an idea how long this is going to take. We're doing 20-some thousand permutations or optimizations. I'm not going to let this thing sit here for 35 minutes. But what I've discovered is, there it went down to 19 minutes. The faster this, or the deeper it gets into the analysis, the quicker it goes. And that's basically what a genetic optimization does. A genetic optimization will go down a path, and if that path doesn't fit the criteria or the fitness criteria, it backs out and starts another path. So that's the beauty of genetic optimization. So I'm just going to pause the video and let this get to its end, so you won't have to sit there and watch it, and I'll be back with you. Okay, that took about a little less than 18 minutes to do the optimization. Let's look at these numbers real quick. We'll squish this down. Yeah, look at the net profit jumped up to $1.2 million. And we can sort by net profit, gross profit. I like to look at the max drawdown numbers too, just to see if we can find a very low risk averse version. There's one at 154 and at $1.17 million. And that's pretty good. I mean, that's very good for that type of trading system, trading those different markets. The parameters that chose that are a little different than what I've chose. I didn't really pinpoint down this high of a resolution, but the indicator length was 84, the max trade loss 3150, the max entry risk was 4375. That's just, I just want to demonstrate the capabilities of the optimizer for you with PortfolioTrader. It's really powerful stuff. Okay, so we've looked at the equity curve. Let's look at it one more time. And this uses all the cores in your CPU. It's 64-bit, which is very nice. It makes it very fast. There's the report again. Let's look at the strategy analysis. Equity curve detailed. I've got a lot of stuff going on in the back of the computer. I think it's faster. Let's do a Monte Carlo analysis real quick. There's your equity curve. It just gives you a little quick snapshot of the equity curve. Now let's run the analysis using the Monte Carlo analysis. That's 1,000 iterations. The red is your largest drawdown equity curve. The green is your base equity curve that we just generated, and the smallest drawdown would be this equity curve here, which they all begin. And because it is replacement, they all begin at the same point, they all end at the same point, because we're replacing the trades with the Monte Carlo analysis. Okay, so this is a very good system, as we can tell, but trading those many markets, that can be very expensive, right? So can we do something trading a fewer markets? Many years ago, I did an interview with John Tolan of Trend Channel, and he said, basically, you could capture the essence of the entire 2024 market portfolio with 3 markets. I can't remember exactly which 3 markets you was talking about, but I picked 3 markets which are highly uncorrelated, and so I want to load that portfolio. I'm going to save this one. I'm going to load this portfolio, which I did a while back. It's called Portfolio Small. So this is for the small trader that wants to invest in futures and trade a systematic approach or algorithmic approach. So we're going to do this. I'm going to load it. We got 3 symbols here. We got the FN, which is the euro, the ZS, which is the symbology for Pinnacle for beans, and ZU, which is crude oil. We're going to do the Pegasus-like algorithm with the 4500, 3, 3000, 85, 1.5, and 3. Let's run it. And there's your equity curve on that. Okay, what does that look like? Well, we got $258,000 profit, max drawdown of $39,000, which isn't bad. It's 17.92%. You could trade this with a smaller account. If you were to trade 5 units of this, you would make 1.25 million. And you would have a $200,000 drawdown. So it would be better to trade the bigger portfolio with all the different markets, or you could trade 5 units of this and you just have a slightly higher max drawdown. So that is what I wanted to show you. And again, if you want to find out more about this strategy, of course you have all the source code. Just email me and I'll email you the source code. You have it on your screen. But if you want to, just email me and I'll send the code to you in text or ELD format. But if you want to learn more about all these trading systems, you can pick up my kit, Ultimate Trading Guide kit. Guide and kit, I guess. And that's where I show Aberration, Aberration Plush, CAT-SCAN like, Andromeda like, Pegasus like, Trendweaver. Trendweaver, I don't show one like that, but Hoshay is still selling his Trendweaver. Simple Harmony like, Super Turtle like. I do show you Clonal's system because he's published in a book. I show you Babcock's system because it's in a book. I show you Cavell's system because it's in a book. I also show Parabolic, which is a stop and reverse system, because it's in a book. And I show you a Grand Cayman-like system by Mike Chisholm as well. And that was a very popular system. All these systems were in my top 10 at one time or another when I was at Futures Truth for 31 years. And like I said, you just can go to... Stay healthy. That's my Fitbit. So I want you to make sure you read this disclaimer about the limitations of what I just showed you. It's always good to know. Okay, and I assume by watching the video you understand this disclaimer. Okay, that's it for today. Again, just check out my website, georgepruitt.com. Thank you.